And so I don't have a lot of concern about the necessarily the broader market, but certainly the areas that have been over bought and that are mostly well, not was we haven't really seen earnings expansion to a significant degree. Instead, we mostly saw valuation expansion, and I think that part of the market, those like high valued large cap tech stocks, that's where there's significant downside.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about markets and Fed next move. Lyn Alden says, as their lag effects begin to affect the market, I believe that the public deficit sector, such as the public debt financing, will continue to be fully financed at these higher rates. As more and more debt financing is taken on, year after year, you would start to see a shift towards a much higher average interest rate. This is also true when looking at the corporate sector, where a lot of the bank lending sector to commercial real estate or other sources still needs to be refinanced at the higher rate. Even if they stay at their current levels, they would still be effectively tightening. I believe that this is the strategy they seem to be taking for at least a few years. And lots of things Lyn Alden discuss, so please watch the video to end. And share, subscribe our channel Everyday Finance. Thanks.
I expect them to probably try to hold rates in this kind of band for a period of time. They could still get a couple 25 basis point increases potentially, but I think that right now they're going to see as their lagged effects start to impact the market. So like I said before, the public deficit sector, like the public debt financing, still has it fully financed at these higher rates. Basically, over as more and more debt finances year after year after year, you would start to move towards a much higher average interest rate. And the same is true when you look at the corporate sector, when you look at the bank lending sector to commercial real estate or other sources. A lot of this still has to refinance at the higher rate. So merely by staying at the levels they currently are, they'd still effectively be tightening. And so I think that's the approach they seem to be signaling that they're going to do for at least a couple of quarters now. So I think we see a very bifurcated market. I mean, outside of the top 7 stocks, a lot of them are actually pretty inexpensive and non-performing this year. And so I don't have a lot of concern about the necessarily the broader market, but certainly the areas that have been over bought and that are mostly we haven't really seen earnings expansion to a significant degree. Instead, we mostly saw valuation expansion, and I think that part of the market, those high valued large cap tech stocks, that's where there's significant downside risk. And I think that if we enter this, if the market starts to see that we're entering kind of a renewed period of maybe minor inflation, so if energy prices stop going down, stop giving us those offsets compared to some of the other things, and if we have the ongoing background kind of large structural fiscal deficits, you could have this period where the market comes to term with these higher interest rates and then has to re-rate some of these highly valued equities to match that. And I think that's the negative thing for the market. So sometimes when you have a higher period of inflation, you get equities that don't necessarily do well in real terms, but they hold up better than you might expect in nominal terms. For example, if you look at emerging market recession, often the stock market in local currency terms doesn't look like a recession. It's often going flat to up in that type of environment. But of course, that's a pretty extreme environment because you have, usually substantial emerging market level inflation along with that recession. So if we had a type of inflation that's more stagflationary and we still have kind of ongoing background nominal numbers that are decent, even as the real numbers are negative, that's where you could have an environment where the equity market maybe doesn't do as badly as we think it does, or at least certain parts of the market. Another way to look at it is that, for example, during the dot-com bust, the NASDAQ came down tremendously, but if you were looking at, say, healthcare stocks or REITs or, the price of oil or energy producers, there was a lot less drama in those parts of the market or pricing around that area compared to what we look at when we see the major indices. So I think it'll be somewhat sector specific, and I think that much of the negative kind of risk to the market is more in real terms than in necessarily nominal terms. But you can still have easily a 10, 20% drawdown. So I'm still reasonably constructive on energy. When I look at the full healthcare sector, you have to be careful with certain regulatory risks, but overall that's a reasonably priced, value-oriented sector at the moment. As well as I think things like T-bills are attractive in this environment. You don't have to be fully invested in the equity market, and I'm still bullish long-term on gold and Bitcoin at these levels. So I think it'll be somewhat affected. I just think that basically the price is already almost like at recessionary levels. So part of why we've been able to push oil down as far as we have is because we purposely brought on, in some sense, artificial supply while curtailing demand to a significant degree. We've had basically borderline manufacturing recession, kind of slowdowns in certain areas. And so that combination of demand moderation and supply side improvements have already, I think, the energy sector kind of looks like a recession, but I think that it could hold up better than we think over the next, say, 12 months. And then whenever we emerge from that recession, like when we move forward to the next period of growth, I think the issue there is that without a capex cycle, so if there's not a lot of new supply coming online in like an investable time horizon, then I think that, until we have that happen, that the supply side is just going to get tighter and tighter and tighter, and that most of the oil companies, when you look at them right now, they're still prices, though these prices are kind of locked in indefinitely. And even if oil would have dropped to 70 or 60 and places like that, the large caps are still relatively priced for that scenario. So I think the downside risk is somewhat moderate, whereas the upside potential over, say, a 5-year period is pretty significant. Yeah, so later this month I have Broken Money coming out, and what I do is I look at monetary technology over time. So as technology changes, what we use as money changes and how we interact with money. So I cover commodity money, I cover the evolution of bank and banking services, then I touch into things like Bitcoin and digital assets. And so it's not any specific region, it's more about why our current money system is troubled. And I start, for example, the book opens up with a list of examples, mostly from emerging markets, but also from developed markets, of problems with money around the world. And, whether it's structural inflation, whether it's, these periods of kind of big challenges that have been happening to them, and then says, okay, how do we get to this point that we're in now? And so it starts in the present, but then it backs up and says, okay, how do we get here? And how can we maybe change things going forward? So I think it's funny. So those of us in developed countries, we see these kind of mild upticks in inflation, so high single digit inflation, that's kind of our biggest worry. I think that the biggest challenge is for the majority of the world that lives in developing countries, because they have the situation where their political leaders have to effectively manage two currencies, right? So they're managing their own local currency, and then they're also managing their relationship with the dollar. They're a lot of times their debts are denominated in dollars, their inputs, their imports and exports are often dollar denominated, and so they're managing those two types of currency situations. So for example, if you were living in Egypt over the past, say, 2 years, you just got your currency cut in half relative to the dollar, and so all of your savings and your ongoing wages are devalued. All right, so that's kind of an example of where it impacts people in the real world. For those of us in the developed market, we only experience it around the margins. In this recent period, I think, and we're going to have further kind of rounds of this, periods of inflation affect us, as well as when you try to send, for example, money globally. I think, we get an appreciation for how inefficient the current system is, because within any one country, it's fairly easy to send money. But when you start sending money between borders, you start running into how antiquated some of the actual systems are behind the scenes. We're kind of relying on, multi-decade old correspondent bank hops if you're trying to send money internationally. And I think a lot of that is just due for an overhaul. Generally, I don't think so. I think that the way that I kind of end the book is looking at two potential paths. So one is obviously central bank digital currencies. So as they try to modernize their back end of their system, they can potentially fix some of these inefficiencies. The challenge there is that there's obviously privacy issues, control issues, and other risks around that. So instead, I generally have a more favorable view towards open source type of solutions. So things like Bitcoin, as the world, I think, gets more digital, as money gets more digital, if the open source types of monies win, I think that can reduce a lot of these frictions. But of course, the markets for those are still very small. So I think until they're much larger, we're not really going to see a lot of the benefits for the global system.